The thing is, there's so much currently which has been priced in. There seems to be so much froth there. What actually, in your view, is in the price of equity markets right now? And indeed, what gives if we don't even actually achieve some of those rather lofty ambitions for some of the economic data that people are looking at?
So a great question. Where are markets versus where are incremental risk factors, and what does that mean in terms of incremental asset allocation? So as we just said, many markets at all-time highs. Risk factors are primarily facing developed markets at this stage. You're seeing far higher incremental infection rates. You're seeing significantly more idiosyncratic policy issues facing developed markets really on a global basis right now. The outlook for emerging markets, however, is significantly better for two reasons. Number one, investor positioning is significantly lighter across global emerging markets. JPMorgan forecasts $350 billion in potential incremental inflows into EM funds as we look into 2021. We've already seen about 30 to 40 billion of that over the course of the last couple of weeks. And so again, a sign that the tide is clearly starting to shift from a fund flow and investor positioning dynamic. And again, incremental economic growth looks far brighter across emerging markets. We are not seeing the lockdowns that we're seeing on a broad basis. We are selectively, but not on a broad basis across emerging markets. Incremental infection rates remain very low. If we look at active versus total cases for COVID-19, that ratio in EM is extremely low relative to developed markets. And so we see less lockdowns, greater increase in overall economic activity, particularly on the consumer side, and a better outlook for EM as we look forward into 2021.
So we get the bifurcation between emerging markets and those developed economies, and in developed economies we're seeing these equity markets at these incredible levels right now, James. So are people being Pollyanna about a virus? That's the question.
Look, I think in certain markets you are likely to see hiccups. Yeah, I think in certain markets you are likely to see hiccups and significant volatility moving forward. We have seen the VIX go above 30 again for the first time in a while. One of the critical aspects, as you mentioned the vaccine, one of the critical aspects that we're tracking is the willingness to take vaccine across markets. And again, severe bifurcation. Here in Asia, about 95% of people surveyed are willing to take a vaccine. In markets like the US, that statistic has dropped from over 80% this past spring to sub 50% today. And so, yes, there will be issues with distribution. Yes, there will be issues with cold chain logistics, et cetera. But there's also just the raw willingness of a citizen's willingness to go ahead and take that vaccine, which we are not seeing in markets like the US, we are seeing in Asia. So again, on multiple matrices, we see a brighter outlook for Asia. Within region, we've seen severe outperformance from Korea, Taiwan, China as we went through 2020. It's right to be selective in those markets. In markets like Korea, as an example, we are seeing some infections. We are seeing December credit card data, as an example, showing a significant reduction in overall consumer activity. However, we still have a very significant rotational play into exporters, into basic tech components in a market like Korea that keep us positive on certain names in that market.
James, the market's still flush with cash. The problem is cash is looking at the same assets, like you said, Asia, EMs. Is there risk in that alone?
There's definitely risk in crowded positionings. Going back to the bad joke at the beginning of the spot. What I would say, however, is the consensus positioning of ex-US versus US is much less expressed in EM versus US than it is, as an example, in Europe versus the US. That drives the JPMorgan estimate of about $350 billion in the potential for incremental inflows into global EM. And we do see a lot of that coming into Asia right now. And the significant underweight positioning that we're seeing in sub-regions is also important to note. In ASEAN, we've had a situation as of a month ago where for the first time in many years, investors were underweight every single ASEAN market. That's not a situation that we see all that frequently. We're starting to see inflows into those markets. We are starting to see index outperformance, but you're absolutely right. We need to overlay our fundamental view with a view on investor positioning because of the crowded nature of trades across markets and asset classes.